Hello everyone, welcome to the 118th episode of me learning how to trade in Forex. So in the last episode we finished off calculating position sizes. We met newbie Ned, the man who lost most of his account I think because he didn't know how to calculate position size. So we don't want to be newbie Ned. So to calculate our position size, if your account denomination is the same as a counter currency, then we would do this. So amount risked is account balance times by percentage of account willing to risk per trade. Value per pip is then equal to amount risked divided by the stop, and your position size would then be value per pip times by known unit per pip value ratio of the currency pair being traded. And if your account denomination is the same as the base currency, then amount risked is equal to account balance times by percentage of account willing to risk per trade. Amount risked converted to the counter currency is equal to currency pair exchange rate inverted times by amount risked, and then value per pip is equal to amount risked converted to counter currency divided by the stop, and your position size will then be equal to value per pip times by known unit per pip value ratio of the currency pair being traded. So we got through that, and yeah. So now we're on to how to calculate your position size in different Forex pairs and account currencies. So how to calculate your position size in different Forex pairs and account currencies. Date is the 27th. So, how to calculate your position size in different Forex pairs and account currencies. Let's say you want to buy Euro GBP and your broker account is denominated in the USD. In this trade, you only want to risk $100, but you're not trading US dollars, you're trading euros and pounds. How do you calculate your position size? In this lesson, we'll teach you how to determine your position size if you're trading currency pairs that aren't in your account denomination. Okay? I will shrink your position, never. So, if your account denomination is not in the currency pair traded, but same as a conversion pair's counter currency, so if your account denomination is not in the currency pair traded, but the same as the conversions pairs counter currency, example USD account trading Euro GBP, so e.g., or let me just do i.e. USD account trading EUR GBP. Ned, who we introduced in the previous lesson, is back in the US. Today he decides to trade Euro GBP with a 200 pip stop. To find the correct position size, we need to find the value of Ned's risk in British pounds. Remember, the value of a currency pair is a counter currency, aka the second currency in that ratio. Oh no, not in ratio, in that exchange rate. Step 1. Determine risk amount in USD. Okay, let's straighten things out here. He's back trading with his US broker selling Euro GBP, and he only wants to risk 1% of his USD 5,000 account, or 5,000 US dollars account, or USD 50. so only risking $50. To find the correct Forex position size in this situation, we'll need the GBP USD exchange rate. Convert USD risk amount to GBP. Let's use 1.75, and because his account is in USD, we need to invert that exchange rates to find the proper amount in British pounds. Find amount in GBP. So we need to find amount risked. Amount risked is equal to account balance times by percentage of account willing to risk per trade. So find amount in GBP, which is equal to amount risked times by the exchange rate. Currency pair exchange rate inverted. No, times by GBP USD exchange rate. GBP USD exchange rate. So that. Now we just finish the rest the same way as the other examples. So convert GBP risk amount to pips, divide by the stop loss in pips, so that is equal to value per pip, right? Yep. So value per pip is equal to amount risked in GBP times by, divided by stop. So that's value per pip. Calculate position size, finding multiplied by the known units of pip value ratio. So position size would then be equal to value per pip times by known units per pip value ratio of the currency pair being traded. Finally, multiply by the known units to pip value ratio. GBP, so 0.14 pounds per pip times by 10k units of Euro GBP divided by GBP 1 per pip, so 1 pound per pip, is equal to approximately 1,429 units of Euro GBP. Now, Ned can sell no more than 1,429 units of Euro GBP to stay within his predetermined risk levels. Can sell no more than. If your account denomination is not in the currency pair traded, but the same as a conversion pair's base currency, so if your account denomination is not in the currency pair traded, but the same as the conversion pair's base currency, i.e. CHF account trading USD JPY is not in the currency pair traded, but the same as a conversion pair's counter currency, but the same as conversion pair's base currency. Base currency CHF account trading USD JPY. Ned decides to go to snowboarding Switzerland, and in between a couple of double black diamond runs, he opens up his trading account on his super spy phone with a local Forex broker. He sees a great setup on USD JPY, and he has decided that he'll get out of the trade if it goes beyond the major resistance level, about 100 pips against him. Step 1. Determine risk amount in CHF. Ned will only risk the usual 1% of his CHF 5000 account, or 5000 CHF account, or 50 CHF. Amount risked is equal to account balance times by percentage of account willing to risk per trade. Convert CHF risk amount to JPY. First, we need to find the value of CHF 50 in Japanese yen, and since the account is the same denomination as a conversion pair's base currency, all we have to do is multiply the amount risked by CHF JPY exchange rate, which is 85. So there's no inverted in this. So find amount in JPY. Amount risked CHF JPY exchange rate. Now we just finish the rest the same way as the other examples. Step 3, convert JPY risk amount to pips. So then it's to find value per pip. So value per pip is equal to amount risked in JPY divided by stop. Calculate the position size. So position size will then be equal to value per pip times by known units per pip value ratio of the currency pair being traded. So JPY of 42.50 Japanese yen per pip times by 100 units of USD JPY divided by JPY 1 JPY per pip, approximately 4,250 units of USD JPY. Shabam, there you have it. Ned can trade no more than 4,250 units of USD JPY to keep his loss at 50 CHF or less. What's the difference? If your account denomination is not in the currency pair traded, but the same as the conversion pair's counter or base, USD account trading USD Euro GBP, CHF account trading USD JPY, GBP USD CHF JPY, but trading the same as the conversion pair's base. But the same. I still don't get how, like, because these two examples say the conversion pair's base and counter, but they're still not in there though, because what does they say? They said the value of a currency pair is in the counter's currency, is in the counter currency. This is the counter currency, right? If your account denomination, so you have a USD account, is not in the currency pair traded, but the same as the conversion pair's counter currency, so this uses GBP USD, so he's gonna convert his USD into GBP, right? Oh, right. So he's gonna sell his USD to get GBP, and then sell the GBP to get EUR. But then why doesn't he just? Oh no, it's because your account. Right, okay. I was going to say, why doesn't he just use USD account to trade EUR USD? But then, if you're based in a different country, your broker might have different currency accounts. So that's probably why he can't. Oh no, but then you're trading different pairs. It's not like. But I see what this means now. Same as the counter pair, conversion pair's counter currency. So GBP USD. Yeah, I see what it means. But for this one, if your account denomination is not in the currency, but the same as the conversion pair's base currency, so CHF account trading USD JPY. So then you gotta convert your CHF to, I'm assuming, JPY/CHF. Because you're trying to sell CHF to get JPY, and then you would sell that JPY to get USD. So you would need a JPY CHF. JPY CHF. But why is it CHF JPY though? So you would be buying CHF JPY? Because CHF JPY means however much JPY you're selling to get CHF. So why would you use CHF JPY? Surely you would use JPY CHF. Because you're selling the CHF to get JPY, which you would then sell the JPY to get the USD. Huh. Yeah. I don't really know, to be honest. I think this is going to be one of the things where it's like you might just follow the formula and not know how it got derived from, maybe. Hopefully I understand a bit later on, after more reading, in some later lessons, maybe. Or maybe we'll just find out more information in some other information sources that I'll go through later on. But for now, I'm just going to skip this. So summary. Position sizing. After journeying across the globe with newbie Ned and through some basic position sizing examples, you're well on your way to becoming a competent risk manager. Now knowing how to set the correct position sizes is only a part of what it takes to become a pro at risk management. The other part is discipline. Sticking to your stop and predetermined risk comfort levels, stick to your stops and predetermined risk comfort levels, and you'll be sure to have enough after your losses to take advantage of future profitable opportunities. So, whoa. 7/04/2024. Yep. So stick to your stops and predetermined risk comfort levels. Position sizing calculator. Finally, we know that you won't always have a calculator handy or position sizing feature included with your trading platform. So we, here at babypips.com, have decided to take it upon ourselves and have built a handy dandy position sizing calculator for you. Bam, aren't we cool? Use the Forex position size calculator if you need it. Actually, use it first every single time you decide to put a trade on. As the old saying goes, better to be safe than sorry. True. Quiz time, position sizing. Do you know the importance of proper position sizes and how to calculate them? Take this quiz to find out. So, feel free to use the babypips.com position sizing calculator on this one. Let's say you have a $100,000 account and want to risk only 1% of your account. How large should your position be if you are trading GBP USD and plan to risk 200 pips? Right, so you have your account is denominated in USD. So that means if your account denomination is the same as the counter currency, so amount risked is equal to account balance 100,000 times by 1%, so that would be 100. Because times 0.01 should be 100, right? No, it should be, wait, so 1, 2 should be 1,000. So amount risked is equal to 100,000 times 1%, which is 1,000. Value per pip is amount risked, so 1,000 divided by your stop is 200, so 1000 divided by 200, that's 5. So your value per pip is 5. And the position size is 5 times, what's the known, 5 times no unit per pip. Oh, there's actually a formula for this, isn't there? 5 times, hold up, let me just write, what's the formula down? Units of USD JPY, 10k units. Wait, how do you know it's 100 units though? Why would you use 10k here? $10k units. Yeah, I don't really know how it's, but it's probably 50,000. But how would you know whether to use 10k or 100 though? This is the most important skill in a trader's asset. Position sizing. Position sizing is one of the most crucial skills in a Forex trader's skill set. You need to find a position size that keeps you within your risk comfort level. You need to find a position size that keeps you within your risk comfort level. This is the act of setting the right amount of units of a currency pair to buy or sell. This is the act of setting the right amount of units of position sizing. Position sizing, setting the correct amount of units to buy or sell for a currency pair. Which of the following is something we don't need to determine the appropriate position size? Which of the following is something we don't need to determine the appropriate position size? Currency pair you're trading, stop loss in pips, account equity or balance, the percentage gain you wish to get, conversion, currency pair, exchange rates. Which of the following is something we don't need to determine? We don't need. It's a percentage gain you wish to get. Instead of considering the percentage gain you wish to get, you need to identify a percentage of account you wish to risk. Yep. Assuming you have 50,000 accounts with a wish to risk 2% and wish to risk 2%, you want to trade USD CHF with a 50 pip stop loss. USD CHF is currently trading at 0.9. How many units should you trade? Count and wish to risk 2%. So you have a USD denominated account and you wish to trade a USD CHF. So your account denomination is the same as the base currency. So amount risked is equal to account balance. So 50,000 times by 2%. 1% of 50,000 is 1 to 500. 500 times by 2, 1,000. So 2% is 1,000. So 1,000 amount risked is 1,000. Amount risk converted counter currency. So currency conversion rate inverted. So that's 0.9 times 1,000, which is 900. 1, 2, 3, 900. Value per pip is 100 divided by 900 divided by 50. It's 900 divided by 50. Let me just get my calculator out real quick. 900 divided by 50, that's 18. Position size would then be 18 times by no unit per pip value, no unit per pip value. So 18 is it 18,000? Oh, it's 180,000, isn't it? Alright, first calculate the amount you wish to risk. Yep. So we got that. 1,000 USD with CHF at 0.9, multiply that amount risk. Okay, we got all that. Finally, multiply the value. Right, so USD 18 per value per pip. How do you know it's 10k units of Euro USD though? 10k units of Euro USD divided by 1 USD per pip. Don't really get what this bit. How would you get this bit from 180,000 units of USD CHF? You need to perform an additional conversion step and use the pair's current exchange rate when the account denomination is. You need to perform an additional conversion step and use the pair's current exchange rate when the account denomination is. Not that. So the same as a counter, the same as a base. Same as a count base, isn't it? Base. You need to perform an additional conversion step and use a pair's current exchange rate when the account denomination is the same as the base currency. The value of a currency pair is in the counter currency. The value of a currency pair is in the counter currency. Let's say you want to find the correct position size for your Euro AUD trade and you have a dollar denominated account. You will need the conversion rate for which pair? Dollar denominated account. So EUR USD, dollar denominated account. Euro AUD. So you're selling Aussie dollars to buy EUR. So you want to gain AUD. If you want to gain AUD, then you would do AUD USD. There we go. Because you're trying to sell USD to get AUD. Aside from correct position sizing, you need something to practice solid risk management. Discipline. Aside from correct position sizing, you need discipline to practice solid risk management. Calculating position sizes. You know what, let's go to that actually. So, last we'll multiply the value by no unit per pip value ratio of unit per pip value ratio of Euro USD. Unit per pip value ratio. In this case, with 10k lots or 1 mini lot, each pip move is worth 1 USD. But how would you know whether it's a 10k lot though? Where does it say that it's a 10k lot? Because it never said or 1 mini lot with 10k units, 10,000. Yeah, I don't think I'm getting this. Because it doesn't say that it's trading in. Unless I'm like, I just don't know. But it doesn't say that it's trading like 10k lots or whatever, so. Yeah. Oh well, on to the next one. Hopefully figure out later. So. What is a stop loss? So, managing and preserving your trading capital is your most important job as a trader. If you lose all your trading capital, there is no way you can make back the lost amount. You're out of the trading game. If you make pips, you've got to be able to keep those pips and not give them back to the markets. But let's face it, the market will always do whatever it wants to do and move the way it wants to move. Every day is a new challenge on almost anything from geopolitics, surprise economic data releases, to central bank policy rumours can turn the currency prices one way or another faster than you can snap your fingers. This means that each and every one of us will eventually take a position on the wrong side of a market move. Buy here, boom boom boom, stop loss order here, avoided loss. Phew! Being in the losing position is inevitable, but we can control what we do when we're caught in that situation. You can either cut your losses quickly or you can ride it in hopes of the market moving back in your favour. Of course, that one time it doesn't turn your way would blow out your account and end your budding trading career in a flash. The saying, live to trade another day, should be the motto of every trader on the newbie island, because the longer you can survive, the more you can learn, gain experience, and increases your chances of success. This makes the trade management technique of stop losses a crucial skill and tool in a trader's toolbox. Having a predetermined point of exiting a losing trade not only provides the benefit of cutting the losses so that you may move on to new opportunities, but it also eliminates the anxiety caused by being in a losing trade without a plan. So have a predetermined point of exit. Having a predetermined point of exiting a losing trade. Have a predetermined point of exit for a losing trade. Less stress is good, right? Of course it is, so let's move on to different ways to cut them losses quick. Now, before we get into stop loss techniques, we have to go through the first rule of setting stops. Your stop loss point should be the invalidation point of your trading idea. So your stop loss point should be the invalidation point of your trading idea. Remember that time you went on a blind date? At some point you had enough and just wanted to leave. That's a stop loss in the dating game. But a stop loss in the trading game isn't that much different. When the price hits this point, it should signal to you it's time to get out, buddy. Why does my stop loss keep getting hit? Why use a stop loss? The main purpose of a stop loss is to ensure that losses won't grow too big. The main purpose of a stop loss is to ensure that losses won't grow too big. While this might sound obvious, there's a little more to this than you might assume. Imagine two traders, Kylie and Kendall. They both trade the same exact trading strategy, with the only difference being their stop loss size. So stop loss size, percentage of total account balance, Kylie uses 10% while Kendall uses 2%. For each trade, the trading strategy only has two possible outcomes, a profit or loss. True? This means that the strategy exits a trade when the stop loss is hit or when the profit target is hit. Now imagine that both Kylie and Kendall go on a losing streak. They both lose 10 trades in a row. Kendall's account would be down 20%, but Kylie's account has blown her account. I think that's meant to say, but Kylie has blown her account. Kylie is out of the Forex game. Oof. Using a stop loss decreases the risk of blowing your account and work to protect your trading capital. Using a stop loss decreases the risk of blowing your account and work to protect your trading capital. In the next section, we'll discuss the many different ways of setting stops. There are 4 methods you can choose from: percentage stop, volatility stop, chart stop, time stop, and time stop. Ready? Let's get started. So, 4 methods of setting stops. Percentage stop, volatility stop, chart stop, time stop. 4 methods of setting stop: percentage stop, volatility stop, chart stop, time stop. Ready? Let's get started. So, how to set a stop loss based on a percentage of your account. So, let's start off with the most basic type of stop, the percentage based stop. The percentage based stop uses a predetermined portion of a trader's account. Stop uses a predetermined portion of a For example, 2% of the account is what a trader is willing to risk on a trade. I.e. 2%, let's go 1% of a trader's account. The percentage risk can vary from trader to trader. More aggressive ones risk up to 10% of their account, while less aggressive ones usually have less than 1% risk per trade. Once the percentage risk is determined, the Forex trader uses his position size to compute how far he should set his stop away from his entry. This is good, right? A trader is putting a stop which is in accordance with his trading plan. This is good trading, right? Wrong. You should always set your stop according to the market environment of your system rules, not how much you want to lose. Wait, it was? So we don't use a predetermined portion of our account. So you should always set your stop according to the market environment or your system rules, not how much you want to lose. So wait, so percentage, so this is the wrong definition then. You shouldn't do this. We bet you're thinking now, right now, huh? That doesn't make any sense. I thought you said we need to manage risk. We agree that this sounds confusing, but let us explain with an example. You remember Newbie Ned from position sizing lesson, don't you? Yep. Newbie Ned has a mini account with $500 and the minimum size he can trade is 10k units. Newbie Ned decides to trade GBP USD as he sees that resistance at 1.5620 has been holding. As per his risk management rules, Ned will risk no more than 2% of his account per trade. At 10,000 units of GBP USD, each pip is worth $1 and 2% of his account is $10. The largest stop Ned can put on is 10 pips, which is what he does on his trade by putting a stop at 1.5630. 10 pip stop loss, testing resistance. But GBP USD moves over 100 pips a day. He could easily get stopped out at the smallest move of GBP USD. Because of the position limits his account is set to, He's based his stop solely on how much he wants to lose instead of given the market conditions of GBP/USD. Let's see what happens next. Stop too tight. Missed a 100 pip move. And bam, Ned got stopped right out of the top because his stop loss was too tight. And aside from losing this trade, he missed out on a chance to grab over 100 pips. For that example, you can see that the danger with using percentage stops is that it forces the Forex trader to set his stop at an arbitrary price level. The danger of using percentage stops is that it forces the Forex trader to set his stop at an arbitrary price level. Either that stop would be located too close to the entry, like in newbie Ned's case, or at a price level that doesn't take technical analysis into account. For all you know, you could be setting a stop right at that level where the price could turn and head your way. Who hasn't seen that before? But because you already got stopped out, you won't be able to bag those pips. Darn it. The solution for Ned is to find a broker that suits his trading style and starting capital. In this case, Ned should trade with a Forex trader that allows him to trade micro or even custom lots. So his was it because he's currently using the 10k lots, isn't he? 10k accounts, 10k units. So he should be doing 1k basically. At 1k of GBP/USD, each pip is worth $0.10. In order for Ned to stay within his risk comfort level, he could set a stop on GBP/USD to 100 pips before losing 2% of his account, instead of 10 pips. The maths, 10 pips times 100 pips times 10 cents, or $0.10 is $10. He now has the ability to, which is still the same because he's still willing to risk 2% of his $500 account, which is $10. So he now has the ability to set his stop at the market environment, trading system, support and resistance, etc. So I should put however, the danger of using percentage stops that forces the Forex to set his stop at an arbitrary price level. You should always set your stop according to your system rules, not how much you want to lose. Find a broker which suits your trading style and starting capital. Find a broker Find a broker which suits your trading style and starting capital. Okay. I'm going to leave this episode here. So in the next video we're gonna carry on with setting stop losses, with how to set a stop loss based on support and resistance from charts. So thank you all for watching, and I will see you all in the next video. Peace!